Good morning. Welcome to the Australian Early Finance Briefing for Wednesday, the 18th of November. My name's Nick here in Melbourne, starting with the latest Bank of America Global Fund Manager Survey results, and they're quite interesting. They're incredibly bullish. So this is the monthly survey, and this is the one conducted between the 6th of November and the 12th. And it's shown that economic growth expectations are at a 20-year high amongst fund managers, and equity risk and everything's up really high. So allocations to equities in November rose to a net 46% overweight, which is what Bank of America call extreme bullish. In addition, they said that 91% of surveyed investors expect the economy to be stronger in the next 12 months, and 66% believe that global growth is in an early cycle phase as opposed to a recession. So they go on to say fund managers have not been this optimistic for global profit expectations since 2002. So they go on saying a second wave is a tail risk of the pandemic, but otherwise the expectations are really bullish. So they also mentioned 73% of investors expect a steeper yield curve, which certainly we're seeing that this week with the 10-year in the US up above 90, as well as the Australian up above 90. They see that tech's the world's most crowded trade, but they also mention that there's a net 24% that expect value stocks will outperform growth, which is the highest that's been since February 2019. They also see that emerging markets, the S&P 500 and oil will be the asset sort of classes to outperform next year. They go on to mention that exposure to EM is rising, with a net 36% of investors overweight emerging market. However, that could be increased further, and they see that currencies, EM currencies, are undervalued, which would be consistent with a sort of bullish overall expectation. Interestingly, UK stocks remain the survey's biggest underweight, perhaps due to the severe second wave we're seeing there. And back here in Australia, the ABS has come out with the October payroll data, and it once again confirms this sort of V-shaped recovery phenomenon, which we have seen here, US, Europe, etc. When things reopen, they reopen quickly, and the economy bounces back very quickly. So, of the 935,000 jobs that the Australian newspapers mentioned that was lost during the sort of lockdown, the COVID recession early this year, about 600,000 of those are now back, so about 2/3. That was only to the end of October, so that does not include the significant increase in reopening that we've seen here in Melbourne since the start of November. Retail reopening, restaurants reopening, lots of big employment sectors reopening. So more positivity there. In addition, they do mention that the tightening of the JobKeeper eligibility for businesses at the end of September did have quite a negative impact on small business employment nationally, where they found that firms with under 20 employees had payroll numbers down 4.9% since the start of September. So some small businesses there shedding staff, potentially ones they probably would have got rid of if they had to pay them earlier. But once again, positive news there, and it does sort of bode well for a very bullish, sort of strong recovery case for Australia and any sort of developed market. And moving to the markets now, it looks like the soaring infection numbers in the US are starting to get on investors' nerves. We've seen a big rally in particularly the small cap domestically exposed US names there, coming off a little bit today. Nasdaq's flat an hour and a half before open, whereas the Russell's down almost 90 bips. So maybe a bit of profit taking, but also these a million new infections in a week are sort of probably getting on people's nerves. In addition to that, we've got Tesla has finally been allowed into the S&P 500 index. It's up 10% as a result. That's your update for Wednesday. Have a great day.
This podcast is for investment professionals only and should not be relied upon by private investors. The podcast is provided for informational purposes only and does not constitute financial advice. The values of investments can go up or down, so you may get back less than you initially invest.